Greetings everybody and welcome to this video. We're going to talk about the QBID, which is the QBID or Qualified Business Income Deduction. Let's hit it. All right, guys. So this is going to be a short video. It never is very long. We're going to talk about QBID, and then we're going to calculate the business deduction deduction for qualified business deduction. Now, let's talk a little bit about this, and I'm actually going to expand this a little bit, mostly because the videos really don't do this topic justice. It's not so much that you know that. I mean, you need to know a little bit. What you know on the slide is good. Okay, that's what you need for this test. Once we get to this third section of the course, where we're talking about chapter 9, chapter 20, we really need to know this stuff, okay? And we're going to talk about it a lot. Now, the history of QBID is such that it's a deduction that's existed for many years. What they did was, and I'll tell you a little story about this. So what happened is that they were getting ready to argue the Tax Cuts and Jobs Act, and they were trying to figure stuff out, blah, 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 so on and so forth. And what had happened was the corporate tax rate, they wanted to bring it down. In fact, at one point, President Trump was trying to say, hey, we're going to bring this down to 15%. And what ended up happening was, as they were and they hadn't really settled on a number yet, went from 15 to 18 to 20, and then they were kind of going around doing stuff. But I remember in a congressional hearing, and I was listening to this because I really didn't have much going on at the time. This congressman was asking the Treasury representative or the person who was talking about the tax bill, hey, you've got these C corporations that are going to go down to 20 or whatever percent, 15 or 20%. What's going to happen with all these pass-throughs? Because pass-throughs, like your Schedule Cs, your partnerships, and your S corporations, they don't pay taxes at a flat corporate tax rate of 21% or 20% or 15%. They pay at the individual's marginal tax rate, which could, under this bill, be as high as 37%. So it made it sound like that if they give this huge tax reduction to C corporations, but didn't do something similar for the S corporations, partnerships, and Schedule Cs, what's going to end up happening is they're going to have a much higher tax burden. Now, something you have to understand, C corporations predominantly, run the gambit. They're small businesses all the way up to, Fortune 100 companies are C corporations, okay? Typically, S corporations, partnerships, and the Schedule Cs are usually mom and pop type things. They're usually small businesses. And small business makes up about 80% of the United States in terms of its business. About 80% is actually small business that actually employs people. Okay, so basically what's going to happen is we're going to reduce this down to for C corporation, was going to give a huge write-off to all these guys that, like I say, go with the gambit. It just looked like we were kind of sticking it to small business, and they were. I don't think intentionally. Because, I think I still remember the face the guy had when he heard, oh yeah, it's like it hadn't registered to them. And so they went back and they said, okay, we need to come up with a way to reduce their tax burden too. And in the past, there used to be this thing called DPAD, Domestic Activity Production Deduction. And what the DPAD was, in order to encourage construction and manufacturing, we gave a tax deduction to businesses that did manufacturing and construction, because we wanted, again, if they build that, it generates economic growth and it has ancillary effects like you wouldn't believe. And so, I know about this because I worked in construction accounting for a while, so I would actually calculate DPADs all the time. I remember when I was looking at what QBID was, I was like, wait a minute, this looks familiar. Looks like DPAD. And it pretty much, the way they calculate it under the new rules, kind of that's how it is. Okay. But DPAD basically says, look, we're going to give you a deduction up to, and I think it was, and I'm trying to remember because DPAD's been gone since like 2016, so I don't really do it. But I think under DPAD what happened is you got 20% of your income as a deduction up to 50% of what they called QPI, okay, which is qualified production activities income, or your W-2 wages. Because the whole goal of this is that as a construction company, they want you to employ people. So they're not going to give you even if you're going out there and you're manufacturing stuff, you don't have any employees, they're not going to give you a tax deduction off this. Okay. So when they took QBID, it's pretty much the same thing. It's 20% of your business income, but there's a limit that it says, look, and one of the limits that they put for this is it's got to be, it's basically you can do it up to your wages. There's wage limitations and taxable income limitations, as it says in point 2. And we'll talk a little bit more about it when we get to chapter 9 and chapter 16, or actually chapter 9 and chapter 20. But that's what they had here. And so, so they're like, okay, this is great. We're going to go ahead and we're going to do this. Well, one of the cost saving measures they did under the old tax code, C corporations that were what we call professional corporations, accountants, doctors, lawyers, architects, engineers, things of that nature. In order to prevent income shifting, because, back then corporate tax rates used to be income graduated just like they are for individuals. But in order to prevent income shifting, in order to lower tax burdens and things of that nature, all professional service corporations were flat taxed at 35%. Okay, and that rate pretty much was established for a reason, that they didn't want somebody owning a C corporation and playing with the numbers in order to get the lowest tax rate possible. Because when you're the owner of the company, you can control what you pay yourself. I just like, okay, well, I've got the cash, but do I want to pay myself as a wage or a dividend? It can go either way. So in order to prevent you from goofing around, they said, we're going to flat tax this at 35%. And that's a magic number because if you did mathematics a certain way, it was very difficult to get the most benefit of it unless, at certain income levels. And I don't want to get into it because it doesn't exist anymore. It's not important for you. But somebody came up with this thing that said, look, most doctors, lawyers, and accountants' offices are S corporations or partnerships. If they're in one of these kinds of industries, more likely than not, they don't have employees. So we want them to get the benefit of this. But if they're one of these fat cat rich places, we don't want them to get any benefit from this because it reduced the cost to them. Again, cost from Congress's perspective. Because when they give you a tax deduction, it costs Congress money is the way they look at it. And so they came up with this specific service trade, or SSTs as we sometimes call them in the industry, that basically says, hey, if you have these SSTs, we're not going to put the employee W-2 requirement on you. We're not going to put the asset requirement on you that they have. But what they're going to do is they're going to say, look, if you make more than, and this year they're saying married filing joint tax returns, and it's got to be taxable. This is taxable income, not AGI. That is actually a trick question they could ask you on the test. QBID does not talk about AGI. They talk about taxable income. So $364,200. So if I have an AGI client that's got an SST, and we're talking, $400,000 or more of income, more likely than not, they're not going to get QBID, or it's going to be phased out. Okay. Now that 182,100 is for single people. Take that, double it. Joint returns is 364. And then what will happen is if you're under that amount of income and you have this pass through, what's going to happen is you will get a full tax deduction for the 20% of your business income. Okay. Good deal. Now, and I'm kind of mentioning this now. It's not important for test 1, but for test, it could be a member of test 3. More likely it won't be, but it could be. S corporations, one of the problems we run into with this, the only thing that's eligible for QBID is S corporation income. So the owner's salary that they pay themselves to the W-2 actually pulls that money out, is no longer QBID eligible. So that gives a further incentive to pay less money. And when we talk about S corporations in another video, and by the way, if you're taking my class in 2024, S corporations isn't part of the required curriculum. I am shooting a video series about them because I want to do that and get that ready for everybody. But that's kind of what's ended up happening with this, is that, there's and we'll talk about it in an S corporation video. There's a huge incentive for people not to pay themselves as much money and instead take it as dividends, because anything that you pay yourself as a salary is subject to self-employment tax. Well, Social Security and income and Medicare tax, not really self-employment tax, but it's the same tax regimes. But anything that's dividend out to you does not go through that system. And so there's a huge incentive to do that, and the IRS cracks down on that a lot. But this causes an even bigger insinuation not to want for them to do that. And so we'll talk about that more later on when we get to the S corporation video. All right, folks, even though I did kind of expand on that a little bit, it's still much shorter than the other three videos were. And I want to say thank you very much for watching this. And again, if you have any questions, feel free to reach out to me on my GMU email, and I look forward to seeing you guys in class.